Stock market opened relatively flat considering the news that Credit Suisse actually was a take under as they spent the weekend trying to figure out how to put the pieces together. Now, we could see the rally and then the subsequent sell-off, but what was more important than that sell-off was just how we hung in here. Now, we are seeing buying across several sectors going into the Fed meeting. We are seeing some banks absolutely implode while others are flourishing. We need to address that and two very specific indicators that have been telegraphing the moves rather well. Now, the other thing we should really discuss is what's going on with the NASDAQ. Why does the NASDAQ consistently outperform the S&P now? Why are people buying technology stocks? What do they know? Is it because of what the Fed is doing with their balance sheet? Now, one of the most important signals that I have seen is what's going on in the S&P. There's a very specific pattern here we're going to address. And I want to show you two very specific things that you need to pay attention to. First and foremost, you have Thursday's move followed by Friday's somewhat reversal on this key level right here going across 39.55. You can see how we've tested this level, reversed, bullish engulfing, and then we just slice through it like Swiss cheese. Another bar inside. So what we have here are double inside bars. Now you have double inside bars. What you have is what we refer to as a 3-bar pattern, where this bar is half the distance of this one and this one is inside this one. It's a pretty specific pattern, and it usually means that you're going to have a pretty volatile move in the way of the leading bar, which would mean that we're going to move up. It doesn't always work that way, but I would pay attention to what I just went over because it's fairly accurate. Now, if we just very simply drill into a couple key indicators, we drill into the 200-day moving average. You can see our 200-day moving average here. We broke below it, we bounced back over it. So here we were under it the entire time fighting. Now you're forming a flag right under a key resistance area. So we are above the 200-day moving average. We are above the 9 EMA. So you're getting above some really key levels that people use to make decisions. Let's watch this on the 5 SMA and see the difference. You are above the 5. So you've now been above the 5 SMA for 3 days and you're pointing which way? Straight up. It's a great short-term indicator. Now, if you want to see even a better short-term indicator on just whether or not you should be looking at a move, you just take the 5 and you make this a 10 and you look how close they are to a cross. And usually if you can see some kind of cross in here, that's usually a pretty good telltale sign that you're setting up for some kind of at least a push up. You had one right here. You can see how that went. Sometimes they're longer than others, but those 5-10 crosses should not be overlooked. So we know that we're above the 5. We know we have our pattern. We know where our level is. Is there anything else that we could use? And the answer is yes. We could look at volume by price. So if we take out the moving averages, overlay volume by price, and then just pull back and look at this level over, let's just say we look at something like a 12-month period, which is probably not the worst time frame to use right now. And we just zoom out. What level are we sitting at? The red level is point of control. You can see how you have the majority of volume sitting right here. This is a classic example of an area and a battle that's going on. So you have the 9 that you're above, you have 9 EMA, you have the 5 SMA, you have the 200 SMA, and you're sitting right under point of control with a 3 pattern. It's pretty intense what's going on there. And it's interesting that you're this strong because the news that's been coming out has not been great. Credit Suisse was a take under. There's no other way around it. We're not going to spend a lot of time on it. I just want you to understand a couple key things. We couldn't even get back up here. They couldn't even get a deal done where the stock was about 2 weeks ago. This is very troubling to me because these types of deals, they drag on for months. And what got me over the weekend was they got rid of a series of bonds. Now, these series of bonds were very risky bonds, and it was in the charter that they could get rid of them should something like this happen. No one ever reached the charter. Now they're going to wish they did. But to leave equity around while you get rid of bonds, it sets a pretty dangerous precedent. So quite frankly, I was surprised that we rallied today. Now, this deal is supposed to be done at around 72 cents. You see how we're at 94 cents. This happened before with Bear Stearns. Bear Stearns, JP Morgan, one day tried to buy them for like $2, literally gapped down 90% one day. And then within 2 to 3 months, it became increasingly clear over time that the shareholders, even though they were told that they didn't have a say, pretty much just like Credit Suisse is being told they don't have a say. All of a sudden, guess what happens? They have a say and they start negotiating a better price. I think that's why we're seeing this start to bid up. I think that's why we're starting to see this move besides the short covering. It's highly speculative, but the way that this was structured and the way that they moved was very troubling because it really came out of nowhere with how aggressive they were. They should have been on this a little bit sooner and spent a little more time. And then all of a sudden they're trying to get one of the largest banks in the world to close a merger. And they're basically wiping away the equity. And they wiped away $17 billion in bonds. Nobody wants to see that. Now you would think UBS would be up because they got such a great deal. But UBS is not really up, is it? Actually rallied up on such great news only to sell back down. And this stock is going to lead Credit Suisse to some extent because now you're going to trade very close to one another. That said, I do think that UBS is going to have to raise the price, but the deal overall did not inspire confidence. The fact that the Swiss government had to bail them out with a $100 billion backstop is not what you want to see. So we have one of the largest bailouts of one of the largest banks in the world, even though it was extremely poorly run. And what are we doing? We're sitting on point of control. We are above the 200-day moving average. These are classic signs of things that we need to be paying attention to. And what's more troubling to me about it than anything, this is the 55. What's more troubling to me about it, and there's the 5 and the 10. I don't understand why you're not getting follow through. And at the same point, I don't understand why we're not breaking down. I can only show you what's going on because when I look at the market and what I see issues. And I see issues on the regional side, regionals, because I trade what's in front of me. In other words, I can be short this all I want or long this all I want. But the bottom line is, since this doji formed, we have yet to break it. Now, maybe we do break it, maybe we don't. But at the end of the day, if you're starting to look at these regional banks, a lot of them are holding. And you're building support here. Now, you have one pin that's becoming an issue, but you have others that are not. Now, the most troubling thing for me, and this is from somebody that I have it's hedged now, but I have preferred of this. I have preferred stock of FRC. I actually have common puts against it right now. Now, the reason I did that was on Friday, they came out and made an announcement. Their announcement was very, very clear. By the way, we're going to do a private placement. Usually when you make a statement like that, you have something lined up. Well, whatever they had lined up was either 1, so poor, or 2, they backed out, or 3, they want more time, that the stock actually wound up and then gapping down, but you gapped down on today, and then you wound up going even lower, and then you closed at the low of the day. So here we are closing near the low of the day. You must have halted at least 3 or 4 times today, and this is exactly not what you want to see. You just started rolling out of nowhere. And we just kept waiting for news. And then it became clear, oh, JP Morgan's working on it. That's not what people wanted to hear. What people wanted to hear was that Buffett took a 5% stake in the common and got 5% of the company at an 8% yield or something along those lines. That's not what happened. This is what happened. And that's not what you want to see at all. So this became problematic. And what we're seeing after hours is we're continuing to see it get worse. So my point, everything's getting a little more complicated and you're seeing some cracks, but at the same time, what is the S&P doing over and over again? Consistently hitting what? Higher lows. And it's not just doing it once, it's doing it over and over again. And that's really what you want to pay attention to. You set up, you hit a low, you retest that low, and then you rally back up. Retest a resistance point, which you can see is 39.50. We've talked about it ad nauseum. Comes back down and then tries to rally again. So the S&P in and of itself is holding in there. That's unequivocal. And it's doing that while certain financials are having a problem. And I say certain for a reason. Now, very quick article here. And this is what happened over the weekend. The Federal Reserve established a fresh line of U.S. dollar swaps with 5 other major central banks in an effort to ensure smooth funding conditions in the wake of mounting concerns for the health of the global financial system. The Fed said it would increase the frequency of so-called swap lines, which provide access to U.S. dollar funding from weekly to daily. In other words, this funding was given weekly. Now this funding will be given daily. It's with the European Central Bank, the Bank of Japan, Bank of England, Bank of Canada, and NYCB. The network of swap lines among these central banks is a set of available standing facilities and serves an important liquidity backstop to ease constraints in global funding markets, thereby helping mitigate the effects of such strain on the supply of credit to households and businesses. Okay, now, why is this important? Since the Fed has increased their balance sheet, and this is a bone of contention with people that this is not really QE or quantitative easing because it's being done through the discount window. To me, we're splitting hairs. The bottom line is you're looking at an environment right now where you can see that on Monday, you have a bottom on the NASDAQ 100, right? Very clear that you have a bottom sitting right there, okay? It's unequivocal. And now you can see where you're at. You're forming a flag. You broke out on Thursday. You went sideways, quad witching, and now you're forming a flag. These are all facts. There's nothing that you can do about it. Why is this happening? Well, if the Fed decreases their balance sheet, equities are going to sell off. In other words, this is all when the Fed is decreasing their balance sheet. This is when the Fed was increasing its balance sheet. What is the Fed doing right now? Well, it's increasing its balance sheet, and I don't really care if we're splitting hairs here and you're saying, well, they're not, it's the discount window. Well, you just went from daily, which you are now, and you were weekly. So as that money turns over and they don't have the ability to meet the funding, that money has to go somewhere. That debt that that bank just borrowed has to go on somebody's books, and it's going on the Fed's books. No matter how you split that, you're splitting hairs. So I think that's a very important distinction. While this is significantly different than the Fed going out there and buying bonds in the market doing, is they are creating a liquidity event, and that liquidity event is going to increase their balance sheet. It's very obvious. Now, if we take a look at the technology sector, this is when the Fed increased their balance sheet. This is when the Fed was decreasing their balance sheet. All right, so we can see this. It's pretty glaring to everyone, I would think. I would think this is glaring. Now, what does it mean? Well, are we increasing or decreasing our balance sheet right now? Well, the Fed's increasing their balance sheet. Since this news came out on March 13th, you've seen nothing but buying in tech since that news hit. So you can call it whatever you want. You can call it, it's not quantitative easing. They're just making the swaps happen daily, not weekly. And that's really what people are splitting right now. That part of the article, they're just parsing these words. And to me, that's just word salad. It doesn't do anything for me. You know, if I get stung by something, do I really care if it's a bee or a hornet? No, it hurts. I just want it to go away. So very similar thing. That's how they're looking at it here. Now, if you look at this level and you can see how you're acting right here on tech, well, this is a wonky cup. This is a wonky handle, and you're trying to break out of that handle above this level. And if we look at Apple, which is the largest position in the XLK, and it does tend to lead, tech does tend to lead the S&P. We've had a real battle going on in this level for some time, and we've been unable to close above this level since September. And here we are again. Now, I just want to point something out that should be glaring. 1, 2, 3. Here you have a 3-bar pattern. Which one executed this? What leads? XLK leads. XLK's leading, and Apple's leading XLK. It's that simple. Don't overthink this move. What you're going to see here is if this continues, this will push, and you will push up into this area. Now, why is Apple so significant here? Well, there's a couple really key things that are going. I'm going to just really quick tip here. And if you like these quick tips, just comment if you want to hear more of them. If they're exhausting and you don't want to hear more of them, just let me know in the comments. But if you look right here, just go back to a 52-week chart, okay? And then drill out so you can see everything, right? You want to get a sense of it, right? And then you want to go out and go, okay, give me a 52-week chart. Because if you go out 2 years since all this started happening, you can see really where your point of control is, which is the red line. Zoom in here, and you can see how that line might change. And then we're just going to pull this over so that you can see that all your volume is right here. So for your short-term trading from July on, and let's go back to a little bit further here so we're on the same page, and we go to April. So now you're about 52 weeks. Well, we're about ready to get into an area that has very little supply. If you have very little supply and you have huge demand, what usually happens? Stocks go higher. Do we have huge demand? Now, this is a graph we've been going over time, And as we refer to it, we do not refer to this as smart money, nor do we refer to this as dumb money. We refer to this in red as retail, and we refer to blue as institutions and funds, because dumb money implies that retail is never right. And that is not the case, as we can see from October here, where retail got invested and then traded up, right? And then retail is the one that sold up here, okay, as the market came down. Now, what's interesting about that sell, while that's going on, what do we have going on here? Well, we have institutions that were completely pessimistic on February at the top that are now pouring money into the market. And when I say pouring, if you look at this chart over 3 years, you do not have another period where you literally are going straight up. In other words, if you drill into this, and let's go out to a 3-month chart, this trajectory has not existed for about 5 years. And they are just going neutral to, I need to get in, and being very optimistic about the market as fast as they can be. Who's selling at the same time this is going on? We're seeing a huge dump in the retail space where they are getting out. Go look at the index, which we're going to in a minute, from when this crossed. The moment that this crossed, where institutional buying overtook retail selling, that is roughly the 9th. By the time you get to it, the next day, it's the 10th. Now, if you drill into what I just went through and you look at our levels right here, let's clean this up, and you look at our levels right here, what do we see? We see something absolutely glaring. At least I think it's glaring. When did Apple bottom? So Apple bottomed right around the same time of this cross. So then we would go through it and say, okay, is there anything else that may have bottomed right around that period in time? And then we just kind of start looking and see if we can find anything else that would fit. Well, here's the 10th, right? There's where the cross is. And then you have that is the bottom. And when you start connecting all these dots, you can start seeing exactly what in the world they are buying. And it's becoming increasingly clear what they're buying. They are buying tech. They are not rushing out. They are not buying XLV. They are not in a hurry to go out there and reduce risk. They are out there buying technology. Now, if you take a look at something like the SOX, and let's pull this back and go out to 52 weeks, and you look at what you're facing here, and you look at our volume by price, it's hard not to laugh at this huge flag and the fact that there is nothing up here a year out. There's literally nothing to stop this when we get over this area. I understand people are bearish. I just went through 2 things that you should be bearish about. You should definitely be bearish about the Credit Suisse deal, and you should certainly be bearish that FRC does not seem to be able to get a deal done. So we should be negative about that. But are there things that we could be about that we're seeing? And the answer is yes. So NYCB, New York Community Bank, caveat, I have a position in this. Now, what's interesting about this one to me is that they are allowed to bid for part or all of SIVB. Now, why is that important? Because the FDIC would have looked into them 10 ways to Sunday. They would have checked them out. There's no way they were going to let somebody else step in here and have an issue. Got right to that 200 rejected. Usually it's the first time. Just first time you try, you get rejected, right? It's not a big deal. You'll probably build in here for a period of time and slowly grind higher. I like this name a lot. I'd like to see a pullback in it, but whether you like the name or don't like the name's irrelevant. The bottom line is the FDIC looked at this bank and said, yeah, you're good to go. Everything's good. So if you're seeing something like that, that means that we have some banks that are in some pretty good shape. PacWest came out and basically opened up their book. Now, when they did that, we saw a couple things unfold. Number one, we saw the stock trade higher from the low right here. At one point, we were up over 20%, which is exactly what you want to see. If you take a look at the PACP, caveat, I have a position in this. You're seeing this trade up over 30% today. And I really like this preferred. I mean, I'll just be blunt. I really do like this. They're coming out and saying they're fine. They have $10 billion to cover some of the uninsured losses, that more than cover the uninsured losses. So they don't have a problem. So that's good news. Now, why did Goldman go up? Well, Goldman went up because Credit Suisse is no longer an issue. So now Goldman is building support right along here. And now we're seeing JP Morgan do something similar. Now, the only outstanding issue I see with what I'm going over, you can see the 200 right here in support. The only outstanding issue that I see on the banking side, unless there's another shoot, And the other shoe that looks like is out there to drop looks like FRC. If they can't get financing done over the weekend and there was no announcement today, it starts getting to the point where it gets a little scary. Why can't you get a deal done? Or do you not want to get a deal done because your terms are so bad? And that's really what we start focusing on. Are you not getting a deal done because your terms are so bad? And that's really what I'm trying to figure out, if that's the issue, and been walking us down this whole time. If you really look at it, again, I have a put position against this and I have the preferred long. But if you look at this, if you break this level, it's going to be pretty nasty. You're going to get to single digits. So I don't know what they're thinking. I don't know what the problem is. There's clearly some kind of issue. They are not doing what Pac West did. They are not doing what NYCB did. So we need to keep that in the loop, and we need to understand that. So now we understand those issues, and we understand where we're at with the NASDAQ. We understand where we are with the SOX. We can see the volume that's been coming in here. We can watch the way NVIDIA acted today and just see what a monster it was. So what else can we ascertain from what happened today? Well, there's one really key lesson that I want to go over with everybody. And if you pay attention to one thing today, please pay attention to this. So this is something that we did in the Alpha Chasers community, and it is something that we are following in the newsletter. If you don't get the newsletter, I would suggest you do. It's free, and there is a link in description. Also, make sure you watch Saturday's video because I cover a lot of ground. And the reason these videos are longer is because you asked for them to be longer, so I read all your comments. So please comment. It's why I create content. So if you see these levels? Okay, so we know where resistance is, and we know where we did not want to buy. You do not buy the breakouts in here. If you're learning anything in this market, you're learning how to trade. You do not buy the breakout. What you do is you look for support levels and then patterns. And right in here is where we purchased Schwab in the Alpha Chasers community through an alert. We bought it right in here, traded up a couple dollars, trimmed a little bit, and we knew where what? Resistance was. So all we were doing in here was watching that bar. That's all we were doing, was watching this bar. We're watching that, and then we form a doji, and we know dojis are signs of uncertainty. Then we broke that doji, and then we broke. Once that happened, that was it. If you were a short-term trader, we just put out the alert to take the trade. That was the end of it. Now, if you're not doing that, you want to pay attention to where you're seeing as far as the previous day close. Once you start breaking that, you can start seeing some weakness there. I don't think this is done, and that's why I'm bringing it to your attention. Okay, I'm bringing this to your attention because I don't think that this trade's done. I'm going to clean all this off, and I just want to show you something that I think is pertinent. Now, I'm going to keep this on a daily because it'll make it a lot cleaner. So here's your breakout bar after you have this long-legged doji. Long-legged dojis are what? Signs of uncertainty. So there's my breakout bar. Did I ever have one close out of this area? Not one, right? So what we want to see is we want to see one close out of there. If I cannot get a close up or below, I have no reason to doubt my position whatsoever. It'd be very clear to me that if I took out that wick, I'd get out of the way. But I just think that this was just pure panic, or get me out. I've made some money, just get me out of the way. A couple other names they were trading today in the community. They were trading SRPT. You can see right here, that is your gap fill down. And then you just had nothing but buying all day. I'm bringing this up because it's probably not over. So once you get into these gaps, you really want to pay attention. That would be the gap fill all the way up to here, roughly 150. Could it gap fill? Absolutely. There's nothing in here. There's really no reason for this not to gap fill. You might want to watch this level, but this company has very little to do with what's going on with interest rates or banking, and that's what people are looking for right now. So they had a little bit of a delay with the FDA. Stock sold down to the level before that was mentioned, and since then, people are taking advantage and they're buying the stock. Now, I think this is pretty significant. You're not seeing any panic. You're going to the Fed meeting tonight. Goldman comes out and says that they are going to pause. Now, I want to be real clear about this Fed hike because this is important. Goldman was the one saying they were doing 25 basis points. They came out this evening at the time of recording this and said they're going to pause. They're not going to raise rates. Okay, there's a reason it's called government sacks. So they pretty much have an inside track. So I would imagine this is also probably another reason why we're seeing so much buying in the tech space. If you are struggling with your day trading, I strongly recommend that you watch this video. I've gotten really good reviews on it. I've had a lot of people tell me that it's very helpful. It's 10 minutes long. Please comment on these videos. It's exactly why I tried to create content. I hope this was helpful. Have a good night, everybody. Stay safe out there.